Okay, welcome to Chapter 1. We're going to start the course out with a little bit of an introduction, give you some terminology, some basic concepts of corporate finance. So let's go ahead and get started. Managerial finance, as it says here, is concerned with the duties of a financial manager. Well, I mean, it's kind of double talk, right? Managerial finance, financial manager. But essentially, what is it that these folks do? The bottom here talks essentially about their tasks. They deal with planning, they deal with financing, they deal with investing, and they deal with strategic planning and implementation. The trio of finance personnel at the top, referred to as the CFO, is the Chief Financial Officer, and underneath that person is the Treasurer and the Controller. The Treasurer essentially is the cash manager, and the Controller is the chief accountant, if you will, of the company. The top manager, again, is that CFO. Again, here, just give us kind of a reviews what we just said. The Treasurer oversees cash management, credit management, right? The Controller oversees the accounting phase. The three things that managers work on. They work on capital budgeting. What long-term investment should the business take on? The second thing, capital structure. Once we've decided what we want to buy, how do we pay for those assets? Should we use debt or should we use equity? And then we're going to talk about working capital management. How do we manage the day-to-day finances of the company? That is the cash management of the company. I want to briefly talk a little bit now about the different types of business forms. And there are three essential forms: a sole proprietorship, a partnership, and a corporation. Sole proprietorship has one owner. Partnership has more than one owner. There are a couple of different formats of partnerships. And then there is a corporation. And a corporation essentially is an entity that has all the legal powers of a person. But the only thing they can't do is vote. Now, the thing that's important to understand is that the financial theories that we're going to talk about and the techniques that we experience throughout this course, they apply to all different kinds of businesses. It could go to profit, non-profit, public, private. They all fit. They all fit all different kinds of business. So let's look at these quickly, one at a time, right? Again, a sole proprietorship is owned by one person. And as you can see here, the red stuff here, quite frankly, I think is the most important part here, is that the tax consequences of a sole proprietorship is less than it is for a corporation. It is taxed at the owner's personal income level. The challenges that we have with sole proprietorship, though, is that it's very difficult to get money. It's difficult to find those extra funds. Once a company has started, it's very difficult to build and grow a company. You just don't have that many sources of funds. Unlimited liability has to do with being sued. What happens when a company is sued and they lose the lawsuit and they owe, let's say they owe $200,000? Where does that money come from? In a sole proprietorship, the business's assets are considered to be all at risk. What that means is the business's assets and the owner's personal assets are seen to be in one pile. So if you get sued and you're a sole proprietorship, you could lose your personal assets as well as business assets. The difference between a partnership and a sole proprietorship, quite frankly, is just the increase in owners. It's still going to be taxed at personal income levels. It's going to be difficult still to raise large amounts of capital. But there's two different kinds. We do have unlimited liability, or the chance of losing personal assets, with what's referred to as a general partnership. there's something called a limited partnership, where a few of the owners, a few of the partners will have unlimited liability, and the remainder of the owners will have limited liability. These limited partners are typically what we more frequently refer to as being silent partners. All they do is supply money. They don't manage the company. A corporation, again, is a legal person, right? Distinct from the owners, right? They're a resident of a state. The advantages, it's a lot easier to raise capital. And then, quite frankly, one of the biggest advantages is limited liability. A owner of a corporation, a shareholder, can only lose the amount of money they have invested in the company. So whatever you pay for the stock price, that's the most you can lose. So the company can't come to you and ask you for more money should they get sued and they can't pay the bill. On the disadvantage side, and we'll talk about this when we get to taxation, we have what's referred to as double taxation. Income at the corporate level is taxed 2 times. Taxed both at the corporate rate and then at the dividends rate for personal taxes. So while it's true that corporations have, in quotes, have higher taxes, it's not really the corporations, it's the owners of the corporation have a much higher tax rate than the owners of a sole proprietorship. What about the different sizes of business? I thought this is rather kind of cool information to see. You know, that sole proprietorships, the number there, about 23 million firms. That's about 61% of all the firms are sole proprietors. Partnerships, a smaller piece, but corporations are roughly a third the number. However, when you look at the percentage of receipts, right, it's 40 times more revenue is created from corporations than sole proprietorships. So if you think about what happens in the government, where they're talking about we need to get more money to the small business owner because they create business, they create jobs. Well, they don't really create a lot of receipts for the company. They may create some revenue from in the form of some income taxes, but the receipts are actually very little compared to corporations. So how is managerial finance related to economics? And there's a lot of ways we can talk about this. Primarily, there's 2 things. It's the supply and demand mechanism. Supply and demand mechanism is very useful in understanding stock prices and how investors influence management's actions and ultimately the changing wealth of the company itself. The other economic tool that's very important is what's referred to as the marginal cost benefit analysis. And this really narrows everything down to really one question. All financial decisions are based on, do you make more money? Do you feel like you've made more money? Are the benefits of doing certain actions greater than the cost of doing those actions? And that ultimately is one of the foundations and the principles of decision making, is this cost-benefit analysis. How does managerial finance relate to accounting? Well, they are overlapped. They're certainly closely related. We use accounting information a lot of the time, obviously, because it's the information about the company's business that we gather. But one of the things, quite frankly, that's different is the focus. Accountants use a double journal entry system for the most part. They use what's referred to as the accrual method in accounting, where in finance we primarily focus on cash flows. Well, why do we do that? We do that because the methodology of accounting can be changed. You can change the way you report certain activities, and since the way you report them affects both the income statement and the balance sheet, you can manipulate, in a legal sense, the outcomes of a company on their financial statements by changing accounting methodology. On the other hand, when we're making financial decisions, I don't want the variable to be changing. I want it to be something I can count on, something I can touch, something that I don't have to worry about any manipulation, if you will. And that variable is cash. So we're going to concentrate on the calculations of cash and obviously using accounting information to do those calculations. And here's kind of an example about how this works, right? We have this company, they sold a yacht, all right? 100% of that is sold on account. So down below here, on the accounting way, we have $100,000 in revenue. It cost us $80,000 to buy the yacht, and we've already paid for that. So the net profit of the company is $20,000. But on the cash basis view, no cash has been received yet, but we did pay for the product, $80,000. So we actually have a negative cash flow of $80,000. So, I mean, which would you rather have? Which looks better to you? Does it look better to have $20,000 in profit or to have negative $80,000 in net cash flow? Remember, this is the same company. The outcomes, the process of using accounting and finance information will sometimes give us some very drastic differences in outcomes. So to kind of narrow this back down, finance and accounting also differ with respect to the decision-making process. Accountants are primarily responsible for collecting and presenting financial data. Financial managers evaluate those statements, and we make decisions on the basis of the assessment of the risks and returns found within those financial statements. So accounting is a reporting kind of a function. Financial managers reflect more of a decision-making function. Well, that's the end of part one. I'm going to put these, most of these lectures will be in two parts, so that will make watching them a little bit easier, and of course storing them and downloading them is a little easier as well. I'll see you back at part two.